the first thing I wanted to focus on, because I think that this is the one piece that we can really regulate and that we can really develop policies around, is the mortgage origination channel, right? We can't regulate people's patience, but we can regulate and we can think about policies to influence mortgage origination. So that's what I focused on. In this presentation today, I'm only going to focus on people who went to mortgage brokers as one way of originating a local context that originates the loan. But I'm also looking at things like whether or not they went to a CRA-regulated institution through the retail arm of a branch. I'm looking at other processes that are related around the origination channel. And the first thing we found is that there's huge local variation in where people use mortgage brokers. So this is the same map as you saw earlier, but this is the percent of loans that were originated by a broker as opposed to the retail arm of a lending institution. And what you see, the areas in green and blue are sort of the areas in green are average for California as a whole. So if you're sort of green, about the same number of people in those neighborhoods used a mortgage broker than in every other neighborhood. The areas in orange and red, we saw many more originations by a mortgage broker than we did for California as a whole. And we see this in both Oakland and Stockton. And if you remember the previous maps I showed you, there's actually a nice parallel between these red colors and the ones that are seriously delinquent and in foreclosure. So what are the implications of this for public policy? One thing that I think is really important is that we need to redress differences in borrower credit profiles. I think part of this is financial education. I think part of this is credit repair. But I think that there might also be a vicious sort of feedback loop about people who get stuck in the subprime credit market, which then affects their credit score, which then affects the fact that they get more predatory credit. And so that we see sort of this historical compounding of disadvantage in the credit markets that continues to burden a cost on disadvantaged borrowers, and that continues them to always having to pay more, always paying more for credit, and therefore never really being able to get out of that type of subprime hole. I think financial education is key, and I see financial education as a three-tier component. One is building cognitive skills overall, right? I think one is disclosures. If we can think of disclosures as financial education in the minute of when you're making the decision. And I was really pleased to see the change in the disclosure laws which show where your loan is relative to average loans in that category, because very few people thought their loan was bad. They said, oh, I got the same rate as my neighbor. Well, if all your neighbors are getting a high-priced subprime loan, you don't know that that's not the norm. And you can't decide that this is not the norm that I should be getting. And so having that benchmark to decide around, I think, is a really important move forward. But I also think that we need to do more about teaching people the political economy of the mortgage market. The fact that brokers' incentives are not aligned with borrowers' incentives came as a complete surprise to most of the people I've interviewed. And I think if you know that that trusted advisor might not be so trusted because decisions they make are not necessarily in your best interest, you're more likely to question that trusted advisor's advice, right? If you know that there might be something up, you're going to go and you're going to ask a few more questions. So I think it's more than just the math knowledge and the sort of finance knowledge. It's also understanding where you sit in the bigger picture of this mortgage lending process. And this is one of my favorites. I haven't convinced anybody of this yet, but I see that we need a better network of linking institutions that can help to build an affirmative credit system for disadvantaged borrowers. We can't just say, okay, let's level the playing field and hope that that's enough, because there's too much historical disadvantage in these communities, too much sort of compounded disadvantage that will make it impossible for these families to ever get access to safe, responsible credit without a responsible intermediary that isn't a profit-making institution. Certainly, I believe that we need to even the regulatory playing field. A large share of these mortgages were originated by independent mortgage companies that were not regulated by the federal regulatory institutions. I think that needs to be resolved. I think that there needs to be more done around broker regulation or broker licensing. I'm not sure what that would look like yet. I think that federal floor laws should be the floor, not the ceiling. particularly in a state like California where there's going to be continued housing demand. I think that that's important, that California should be able to move further in terms of its regulations. Not that it will, because we're bankrupt, but that's okay. So this question of, my time's up, solder sold, I don't know the answer to this yet. I thought there was going to be a really clear picture. I think it was much more of a two pieces coming together, and that both pieces didn't know necessarily what they were doing. So I'm not at an answer there yet, but I do think that this local context matters, and that there's more that we can do to protect borrowers in that local environment.